Okay, welcome back. I'm about to wrap up the review of the Bitcoin 1776 white paper and the World Series of Bitcoin. Previously, we've done an introduction video, a video on economics, a video on the World Series of Bitcoin election system, the system for the Council of Franklins. We've done a video on um, the quotes are the cultural inspiration for the coin, a summary of the attack vectors, and then a detailed breakdown of all the attack vectors. And now we are on to the eighth video, which is to finish up the reading of the Bitcoin 1776 white paper. So we are going to pick up where we left off from previous videos, and we are on page 7, and there are 3 pages to go, or page 10, so 4 pages, I think. Okay. Objections and responses. So this is going to be more on numbers and software, probably like the most boring aspect, I think, or confusing aspect for most people. But if you're a cryptocurrency enthusiast, maybe this is the one you're most interested in. Okay. Objections and responses. If you really hate inflation, why not end it entirely? Bitcoin 1776 does not hate all inflation. Inflation of supply directed toward a purpose which provides greater value to the whole is surely welcome. However, by aligning expenses with reasonable projections, we better protect the holistic accumulated wealth of coins. Eventually, an organization may increase coins to fund a project, seed the wild world, or automate such processes. So long as historical weights and measures remain unadjusted, Bitcoin 1776 shall be initially neutral and welcome the matter to be discussed via forums, public and private, until a quorum is reached and matters settled, without undue bias. So that is simply stating that even though this coin has reduced the rate of inflation from, let's say, over time of 18% to 0.4%, it is not solely because inflation is terrible, but it's more about inflation without a kind of concrete social objective. And funding the development of ASIC hardware, I don't find as a good social objective of Bitcoin or Bitcoin 1776. So we reduce that, and instead we sort of fund social education. And likewise, it might come time that at some point somebody wants to fork off the Bitcoin 1776 software and create some new value. And if society feels that this is valuable, then we will try to be neutral and allow it to be discussed, as opposed to maybe perhaps creating fanatical hatred. Okay, moving on. Where is the programming team, marketing team, or advisory council? While we anticipate the open source community fulfilling some of these functions, this is beyond the scope of this endeavor. One should anticipate no creation of value beyond what one is capable of downloading and using today. The initiating coins or premine will be donated to 501c3 nonprofit Midnight Discovery, which serves the purpose of educating and engineering a robust society. Some of these may be restricted but are not expected to directly contribute value to Bitcoin 1776. Possible examples include restricting 51,375 coins to be sold between $2 and $400, restricting 100,000 coins to be sold between $400 and $300,000, restricting 300,000 coins to sponsor societal leaders and events, 100,000 coins for general use and patronage, released in stages not fully tradable until after 157,500 blocks. Okay, so this statement is primarily there is no programming team, there is no marketing team, there is no advisory council, there is no foundation to protect and promote Bitcoin 1776. Instead, there is a nonprofit called Midnight Discovery, which serves to promote education at large and societal organization at large. Now, the interests of Bitcoin 1776 and those of Midnight Discovery have significant overlap. However, it is not the same as a foundation like the Ethereum Foundation, which I presume is explicitly instructed to benefit Ethereum. The benefit of Midnight Discovery is to be for society, not solely for Bitcoin 1776. However, there will be times when they overlap, such as sponsoring societal leaders and events, or the coins are restricted for this reason, and in those instances, yes, there's overlap. But general use and patronage, this is for education and leadership, an effect as determined by Midnight Discovery. Okay, moving on. So another way of phrasing it is that what people can download, what people can read, this is the terminal output of Bitcoin 1776. Okay, which is to prevent any idea that there will be some future benefits created later on. There are some times where I suggest doing some things in the future, but these are generalized criticisms to society and not objectives of some foundation, because there is no foundation or any promises that I or anyone associated with this product will be able to create in the future. If the global community wants to create it, I of course cannot stop them. And these are my suggestions for direction of the global community, but that is the limit. Okay, moving on. Numerical equations 1 of 2. Assuming a Bitcoin value of 100,000, what is the amount of new supply? 144 blocks are created daily, 6 per hour, 24 hours per day, and 52,560 blocks are created per year. Until approximately May 2020, 12.5 Bitcoins are minted per block, and then 6.25 Bitcoins for the next 4 years. Thus, 657,000 Bitcoins are created annually until 2020, and 328,500 until 2024. This totals 2.6 million 28,000 new coins in the next 6 years. Thus, at a value of $100,000, annual new supply amounts to $665.7 billion, or $180 million, or $180 million daily, and half of this after 2020. If unobtainable consumption can be achieved by inflating dollars, whereby median wages skyrocket from 30,000 to 300,000, or through collapse of Bitcoin value. Funding required over 6 years to sustain a $100,000 price fixedly totals $263 billion. In contrast, Bitcoin 1776 mints 52,560 new coins in said time. At a $10,000 value, Bitcoin 1776 would need $526 million in funding cumulatively, or $5.3 billion for a fixed value of $100,000. Returning to Bitcoin, the level of new supply at a $10,000 valuation is $6.6 billion annually until 2020. However, this type of equating often represents a misunderstanding of the functions of markets. Instead, coins change in value until annual new supply adjusts to equate to annual new demand, less relaxing of concentrated holdings or changes in future expectation, whereby in one calculation value is indeterminable, supply indeterminate, and the results are merely one of infinite possibilities. In the other calculation, value is determined by equating demand to supply. Such a method is more considerate of the intelligence of markets and appreciative of the predictive nature of organic demand. Another common misconception is presuming demand slackens for things that grow more valuable in time. As values grow, concentrated holders sell to better represent their wealth in a spread of assets. This downward pressure cannot be sustained. If new demand for Bitcoin 1776 was consistently 6.6 billion annually, coins must grow until they achieve $500,000 to $1 million in value by mathematic requirement. Okay, so I think that was fairly well straightforwardly presented, but so there is something that I discussed in the attack sector video called the slow drip, and even though the slow drip or the releasing of concentrated holdings can affect a value temporarily, if, for example, the new demand for Bitcoin 1776 was 6.6 billion per year forever, then the slackening of concentrated holdings could not go on forever, and at some point the price would have to arrive at a point of 500,000 or $1 million of value per coin if annual demand was perpetually 6.6 billion, which is approximately what it is for Bitcoin today. Now, another thing I talk about here is so if Bitcoin 1776 was to reach a value of $100,000, then the cumulative demand required over a 6-year period is roughly 5.3 billion, whereas Bitcoin needs this same level of demand to sustain a price of $10,000 per year instead of over 6 years. And then now here I mentioned that if Bitcoin was to be fixedly at $100,000, then this would be $263 billion of demand over the next 6 years to maintain this price point. This, of course, is reduced the longer Bitcoin has a price below 100,000, like $7,000 today or whatever. So obviously, this is a much lower price point now to do it over 6 years. But all the same, it's something to consider in terms of a 6-year outlook. And some people predict a price or a sudden climb in price to like $200,000 for a Bitcoin in 2020. But if something like that happens, I think it would be short-lived as opposed to long-lived. And then here, talking about demand, organic demand or consumer demand is largely predictable in one sense over long periods of time because populations as a whole are slow to move in and out of things without the influence of propaganda trying to create euphoria or despair. So, that is to say that when you think about these things, this is why Bitcoin in particular and these kind of hard assets, you can sort of predict a long-term change in our long-term value based on the historic demand cycle, because the long-term demand just doesn't really change that abruptly. So Bitcoin is holding a value of roughly $7,000 today, whereas maybe 3 years ago or 2 years ago, it was holding a value of roughly $1,000. And so if Bitcoin was to retain its same demand that it held at $1,000, then the value would be $2,000. However, it's around 7,000, which is to represent that the ongoing demand of Bitcoin is roughly 3 times what it was, even though the price is 6 times. Part of that is because of the reduction of reward. But if the price of Bitcoin, that the ongoing demand of Bitcoin over the last 3 years has increased roughly 3 times what it was, and I would say that's about representative of the reality. It's very slow to change over time, but the demand does increase as the reward or issuance becomes reduced. And then also that even though I do make several comparisons from Bitcoin to Kennedy coins, whatever is the organic demand for Kennedy, which obviously is currently at 0 because it's not in existence or like barely is in demand, whatever the organic demand of the Kennedy is, this is what will determine the price of a Kennedy. It's not merely because of a concentrated or a release of holdings. So if the organic demand of a Kennedy was $100,000 per year, and this was ongoing forever, and it never was above or below that, then this would create a price per coin of approximately like $6 per coin. Just because it gets cut in half doesn't mean the coin suddenly turns into $100 million or whatever. It's relative to whatever it was before, whatever the demand was before, because the demand changes quite slowly. Okay, numeric equations 2 of 2. Bitcoin transaction fees are recorded in an invisible unit, the Satoshi. The cumulative payout is relative to the number of bytes per Bitcoin block, and the variable cost per byte as established by consumer demand. Bitcoin is set to a 1 megabyte block size, which allows for 450,000 bytes to be used for exchange of bitcoins. One commonly referenced size per transaction is 225 bytes. Thus, 2,000 transactions fit per block. If 1 Satoshi is paid per byte, then this amounts to 225 Satoshi or 450,000 Satoshi per block per SegWit. Scripting trims to 170 bytes and can sextuple throughput. It could be possible to have 2.7 million bytes used per block, processing near 16,000 transactions. This would alter the subsidy to fee ratio from 2,777 to 1 to 463 to 1. The following calculations are without the use of SegWit. Bitcoin's subsidy is set to 1.25 billion Satoshi per block until 2020 and 625 million until 2024. Broken into Satoshi per byte using a 1 megabyte block, this amounts to 2,777 Satoshi until 2020 and 1,389 until 2024, as opposed to 1 Satoshi per byte of minimum consumer demand, creating a significant imbalance. Each incremental rise in fee of 28 Satoshi adds 1% to block reward and is represented as 6,300 Satoshi per transaction. At $10,000 per Bitcoin, this amounts to 63 cents in fees per transaction and $6.30 in fees at $100,000 values. Bitcoin 1776 improves responsiveness to this uncertain variable by reducing the fixed subsidy to 25 million Satoshi, hereafter Franklins, per block or 56 Franklins per byte. Each incremental rise in fee of 1 Franklin adds 2% to block reward. At $100,000 values, escalating fees by 1 to 2 Franklins per byte amounts to 23 cents per transaction, which is enough to be meaningful but not breaking. Also, during seasonal consumer peaks, blocks could become generated in an average of 7 minutes and 13 minutes off peaks for several days at a time, thereby creating a market reactive block from a human perspective, which can increase the quantity of transactions processed per day seasonally without adding long-term node strain or substantially increasing chances for orphaning blocks, both of which can be caused by too short of block times. Okay, a lot of information there. Let me break this down. Okay, starting at the end, orphaning blocks. So when you have a block time like Litecoin has of 2.5 minutes on a standard basis, and you have a global consensus system, then orphaned blocks can increase. So Bitcoin that has a very long block time of 10 minutes rarely orphans more than 1, 2, or 3 blocks at a time. And Litecoin might be kind of similar, but it might orphan 6 blocks at a time. Now, Bitcoin orphaning 3 blocks is 30 minutes of orphaning, and Litecoin orphaning 6 blocks is maybe 15 minutes of orphaning. However, even though like in human terms, the time frame is roughly the same, but in block terms, if you have a shorter block cycle, then you'll just by virtue have a more frequented orphaned block, because it is difficult for a global network to achieve consensus in such a quick time. Seconds are more impactful than with a seconds of a block time that let's say a 5-second lag time of a block time that is 150 seconds, such as Litecoin, is more impactful than a 5-second lag time of a block time that is 600 seconds, like Bitcoin. Okay, so that explains that. Seasonally, average block times is 7 minutes or 13 minutes off peak. So Bitcoin 1776 is a 10-minute block time. However, because transaction fees are such a big factor compared to what it would be for Bitcoin, for days at a time, the blocks could speed up to 7 minutes or then slow down to 13 minutes without creating too much long-term impact. And then because it's still set at 10 minutes, and also by having a block reset time of 2 weeks, approximately 2,000 blocks, 2 weeks, then this allows for some short-term variability. Whereas if you had a block reset time of every block or every 10 blocks or something, then that would effectively eliminate any possibility of variance. So I wanted to say something on this. I forgot. Anyways, so I think that covers that. But yeah, even though blocks are reset every 2 weeks, you'll commonly hear this, and in Bitcoin, it will be 2 weeks pretty much forever. In Bitcoin 1776, if it's 7-minute blocks, that might finish up in a 10-day period. And then if blocks are 13 minutes, this might go on for 3 weeks, or 20 days, because it's not 2 weeks, it's every 2016 blocks. And the speed of those blocks changes based on transaction fees. So there will be more variance in block times with Bitcoin 1776. Okay. Regarding fee changes, people don't really think about Satoshis per byte right now because they're largely irrelevant. 1 Satoshi per byte is approximately 63 cents of fee difference, which isn't too large of an amount of money to bother people. But if Bitcoin was to increase in value to $100,000 one day, then this amounts to a $6.30 change in fees. So therefore, 1 or 2 Satoshi might create a very big difference one day. I might have no. I phrased this slightly off. No. It's 28 Satoshi I mentioned. I might have misstated that. Regardless, if fees, the main emphasis here is that if the Bitcoin value goes up to $100,000, then a change in Satoshi fees, which represent 1% of block reward, which would be 28 Satoshi per byte, this hardly changes the blocks at all, but the reward for the blocks at all, but it increases the fees for the users by approximately $6 per transaction. And this is enough to where you'll see a lot of people hesitant to use Bitcoin for small transactions if the fee per transaction becomes $6. With Bitcoin 1776, this changes because the fee per transaction are to increase block reward. So if fees go up dramatically, then blocks speed also goes up dramatically. And to make the block speed increase dramatically, even at a $100,000 value, you only have to pay 23 cents, whereas Bitcoin you would have to pay $6, a $6 increase to experience a similar increase of block speed relative to your transaction fee. Okay, here I mentioned SegWit. Most of my calculations throughout this do not reference SegWit, as it was really implemented with strong use before most of this writing was conducted. However, it is important to note, and I did not want to exclude SegWit, it is important to note that even though Bitcoin is advertised as a 1 megabyte block, SegWit allows blocks up to 4 megabytes. There is some header data, etc., which cannot be used, but this can easily increase the transaction throughput from 2,000 transactions per block to 16,000 transactions per block, or 8 times, which then decreases the fee to subsidy ratio by a smaller amount as well. So all of that is important to at least be noted. And then all this is just some historic information that has been used when it comes to calculating Bitcoin block sizes forever and ever. But all of this kind of gets thrown out the window now that SegWit is in quite substantial use. But this was the source of my calculations, which was the historic of all which was the historic reference of all calculations pretty much prior to SegWit. Okay, moving on. Hash power. Hash power is the rope which holds Bitcoin together. Without hash or a low amount, one cannot be certain that they are connected to a proper line of nodes. In an ideal world, that of Satoshi Nakamoto, mining and node operating could never be decoupled. However, it is recognized that it is unreasonable as each successive technological advance creates a multi-billion-dollar competitive edge. And to arrogantly shame those who do not simply share such with the world, openly and freely, is to purport an unreasonable level of social sacrifice upon the industrious intellectuals. In this protocol, payouts are reduced from 8% to 1%, thereby limiting financial control over the platform by hacking or elsewise. Alright, so this is a small discussion of hash power, and the main emphasis here is that preventing ASIC or preventing monopolists from controlling your network is kind of an impossibility, but it's just not within your control to do that as the consumer. But what is in our control is to reduce the payout to monopolists from 18% to less than 1%, which Bitcoin 1776 does. And it just kind of emphasizes what hash does. Hash is the rope that binds the nodes together. So you do need some amount of hash, so you can't get rid of it completely. Otherwise, your nodes don't know if they're connected to the proper chain. But having too high of a hash, like making the rope, which kind of Bitcoin does, making the rope from one that is lightweight and easy to hold to like a giant metal chain that requires, $6 billion of annual funding to support. This produces kind of quite a strain upon those who are trying to use the network because they have to support $6 billion of annual funding. Okay, price finding and arrival of market equilibrium. Blockchain tokens are notably volatile. There are many factors which affect markets or are specific to one project. There are matters public in which actors move independently and matters private in which a few act in concert against. One force which creates the appearance of controlled market is supply cornering. When a small group or single entity controls an unusually high percentage of supply, then presumably these units must become divided over time into an increasing number of hands, reducing general demand, or put upon the trading floor, overloading supply. In either case, this siphoning of demand or overloading of supply, the public is excluded from knowledge deriving such trades and can become lost in fantastic speculations and mired in local superstition. Bitcoin 1776, initiated by awarding 96% of all possible coins in equal ownership to those of Bitcoin as of July 4, 2018. This process reduced the ability for any new entity from seizing over 5% of supply, separated from that of Bitcoin, without purchasing from a prior participant. That's pretty good. That's pretty well worded. Okay, so this is just saying that some coins like IOTA or NEO or whatever, they might represent as having no inflation. However, they have a very concentrated holding, and this concentrated holding in effect must be sold over time, either to fund a purpose or because the people who hold on to these coins don't want all of their wealth to become dominated in such a risky asset. They want to diversify and represent their wealth via a fancy car, fancy house, or whatever it may be. So Bitcoin 1776, they kind of prevent this in some regard by distributing 96% of coins immediately to a diverse range of social interests. And then also in subsequent discussions, it is mentioned how there's kind of forced price points of selling it and repurchasing to reduce the volatility risk. And that covers everything and concludes Bitcoin 1776. Thank you so much for watching. If you stuck through and watched all this, you're amazingly patient. And you should be very well informed about what the goals were of this coin. So, It is my pleasure to present this here to you today. Like and subscribe, and I hope you become interested. Download the software, begin mining. You can mine it with a normal CPU today, and it, maybe participate in our political system. There will be awards for participation, and it may start in the month of November. We'll see if it's going to be November or December, which will start up an online system to kind of get things going and to test our procedures. So I hope to see you there, and follow us for more information. Thank you very much. Have a wonderful week and day, month, and life, and may you leave a legacy that extends beyond your being. Good night, and good luck.